Greetings, members one and all of the Salivation Nation. You know, the precious metal prices took a bit of a dip today after the Trump announced that they would be postponing some tariffs on China in lieu of the holiday season coming up. And so the markets reacted to that. But everybody's still bullish on where gold is going to go, maybe even silver too. But on the road to $2,000 gold, let's explore what that road is going to look like. This comes to us from CNBC, saying that gold could hit $2,000 in a world full of negative yields. A case can be made for gold to rise to a lofty $2,000 level based on the activities of the world central banks and a $14 trillion in negative yielding debt, strategists say. Analysts say gold is attractive in a world of uncertainty and it also shines as the amount of safe assets shrink. In a world full of negative yielding debt, hard assets like gold could become even more attractive, and some strategists say a case could be made for $2,000 per ounce price tag on the precious metal. Well, I'll stop right there and say that based off of recent events in the last week or so, and how the price of gold has really bolted up as of late, it's understandable as to the reasons why it could continue to climb. I'm not quite as bullish, though, really, at least anytime really soon here in the U.S. Obviously, other currencies around the world, especially Canada, it's at record highs. And when you look at the economies around the world, there's a lot of fear there. Even though the economy seems to be doing well in terms of job numbers and employment, obviously, and the wage increases in the United States, there's a lot of other things that could trigger a downturn in the economy. We're overdue for a recession, by the way. But when you look at the whole world, and many other nations around the world are struggling, their economies are on the brink or what have you. I've heard rumors of some banks closing, big banks closing in China are in trouble. And so when that kind of thing, you hear that kind of news and what's going on with Brexit and other events such as the tariffs and trade. And, there's a lot of different things. Iran. And we'll talk about that here. And this article explains some of it. Gold futures were at $15.13 and 80 cents an ounce on Tuesday, down from 2.2% in late May. Gold snapped out of its slumber, broke above $1,300 and has not looked back. In September 2011, gold futures reached an all-time high of $1,923.70. We have a long position trade on. We're targeted at $1,585, says Daniel Gali, a commodity strategist at TD Securities. We do think gold is on its way higher for the time being. Over the coming years, as the likelihood of an unconventional policy becomes more of a reality, he could see a case of $2,000. And here's the gold futures chart here. Gold has also been firming as the world watches protests in Hong Kong. That's another thing. And also the uncertainty around the U.S.-China trade relations. The airport is shut down. It's a huge airport shut down over pro-democracy and protesters. Basically, China is breaking its deal with Hong Kong. And so there's been a lot of, there's more government control. And it's been really inspiring to see some of these protests in Hong Kong waving flags, as long as they don't go subvert to violence. But we'll see how that plays out. Tuesday, gold erased its gains, and risk assets rallied after the U.S. announced it would hold off on tariffs on consumer products until mid-December. TD Securities strategists believe that many years of unconventional and easy monetary policy from the world central banks has resulted in a shortage of safe assets, and that's evident by the fast-growing pile of negative yielding debt, which is ultimately leading to a growing appetite for precious metals. Negative yields are symptomatic for a search for safe assets. The reason they're trading at negative yields is because the demand for safe assets is bigger than the supply for them. said Gali. Gold stands to benefit quite a bit from that. The trade we've been recommending, we have it at a 3-month time horizon. He would argue that likely the cusp of a multi-year bull market for gold. So the negative yielding assets, especially the bond market, is something to be thought about and considered. Obviously, it's a sign that could be a recession in the future. And you heard me in a video talking about Nevada wants to have gold-backed bonds. Bank of America Merrill Lynch's metal strategist Michael Widmer said in a note there's negative yields are making gold shine. He said the successive rounds of monetary easing driving bond yields lower and creating $14 trillion in negative yielding debt have also recently supported gold prices. With more easing to come, the dynamic will likely sustain the bid for the yellow metal. And make no mistake, we're printing money, and there's been some push for maybe a fourth round of quantitative easing, and Trump wants a weaker dollar. We could lose confidence in the dollar. This could spiral downwards relatively quickly if we don't continue and do reverse course in some ways, because we need a stable dollar. And some of this activities at war with China, trying to find ways to do it. There is some cushion there, but how much of a cushion will be there before it gets pulled out from under us? Widmer said all the rounds of central bank moves, including quantitative easing, have clearly delivered less bang for the buck when it comes to stimulus. He said this could result in quantitative failure or an environment where markets focus on a high debt levels or lack of economic growth, and that could lead to volatility. Good point. At the same time, and perhaps perversely, such a sell-off may prompt central banks to ease more aggressively, making gold an even more attractive asset to hold. We have a relatively conservative second quarter 20 forecast of $1,500 an ounce, but in this scenario, we see a scope for gold to rise towards $2,000 an ounce, he wrote in a note. Widmer said central banks are also driving up gold as they have now become net buyers of the metal. And I've mentioned that in prior videos too. Widmer notes that the World Gold Council expects gold reserves to increase over the next year at central banks. The motivation behind the respective reserve strategy varies with historical positioning, the long-term store of value, gold's role in an effective portfolio, diversifier, and lack of default risk, featuring the honest among EM and DM institutions, de-dollarization features, as well as motivation, Widmer wrote. It's quite interesting, and this article here is from oilprice.com, and they're saying that while gold prices are about to skyrocket even higher, this perspective says the gold bears have finally caved under the deafening barrage of fiscal and geopolitical catalysts from Fed hints of intensely brewing conflict with Iran. There's one key trend that stands to push gold up beyond $1,700 regardless of the day's news. Of course, it's difficult for the bears to ignore a nearly $50 an ounce gain for gold, which is now trading well above its 5-year high. Not only has U.S.-Iran conflict reached a boiling point, but Trump's ready to deploy an additional 1,000 troops to the Middle East. But the European Central Bank has issued a defiant, dovish tone, saying it won't hesitate to provide further stimulus. That means rate cuts. The icing on the gold case is the U.S. Fed, which has now clearly indicated that it hasn't abandoned the idea of rate cuts for 2019. But in the perfect storm for gold prices, Euro Sunshine Mining CEO Scott Moore says that overlooking a significant trend will outlast the current geopolitical meltdown, even the Fed policies. It's a global push for de-dollarization. And governments around the world are becoming increasingly wary of the dollar's hegemony in international trade, says Moore, and they're doing their best to distance themselves from it by buying their gold reserves to buy more gold instead. The process is already underway in mainly nations of the strong anti-U.S. sentiment, including Russia, China, Iran, Venezuela, Syria, Qatar, India, Pakistan, Libya, Egypt, and the Philippines, among others. Naturally, these countries are turning to gold since the yellow metal is not only lock and key like the greenback and other electronic payment methods. The trend is abundantly clear when you look at central banks' buying activity. According to the World Gold Council, central banks purchased nearly 70% more gold during the first quarter of the year than they did during the previous year's corresponding period. That's the most they bought since the first quarter of 2013. And, I'll kind of stop there because I think this is the notable thing, and it's been going on with central banks picking up gold, especially in the BRICS nations. Their economies they're still way behind the U.S., but I wouldn't say that de-dollarization is going to happen anytime soon. Gold is the best of the worst. I mean, the dollar is the best of the worst out there. I think it's going to take quite a while, and I think Trump understands this when negotiating with these other nations and making such bold moves. There's something about this dollar. I think the thing to worry about is if these world economies, and because if they start to collapse one by one, it's going to hurt the whole world. Really, it's in everybody's best interest for everybody to succeed. And I think that's kind of been the feeling for quite some time, pre-Trump era in terms of trade and the like. If China succeeds, maybe we'll succeed. Though, beneficial trade and the like, and everybody does well. It's a symbiotic thing, even though we kind of have been kind of screwed over by China for quite some time. But Trump is weighing his options there, and kind of seeing where things play out. But I think there's still some buffer room there. Not to say that we couldn't still hit this $2,000 level, because I think things are different now than they were in 2011. And I think that we're on the road, and I think that the new floors have been built and trussed out. And so where will that lead us? We shall see. And could we get to 2,000 with these bond market yields, with more talk of stimulus? And the thing is, with more stimulus around the world, and even talk of it here in the United States, we've not really seen the effects of the quantitative 3 rounds of it before quantitative easing. So this quantitative failure idea is something that we should consider. What the time frame for it is who knows. But in the end, what matters is that you and I protect ourselves in case there is another recession or an economic downturn. Part of the ways to do that is to have plenty of money in savings and in precious metals, and other ways to protect yourself, even in case of times of a brash economic downturn, to where you need supplies, food, and water, and the basic necessities that would prep for in terms of an economic disaster. Post your thoughts below on gold's road to $2,000. I'd like to extend a multitude of gratitude to y'all for watching, and encourage you to please rate, share, comment, and subscribe.